Wish you all a very happy Diwali and a very prosperous new year. Welcome you all to our monthly fixed income outlook for the month of November. Let us have a quick look at what happened in October. Two key developments were: one, a further enforcement of the direction of the normalization of the monetary policy, both domestically and at the global level by the Federal Reserve. As also in a key development, the Reserve Bank withdrew the continuation of the GSAP or the Government Securities Acquisition Program. So, looking at the monetary policy of the Reserve Bank held early previous month, Reserve Bank continued with the uh, key policy rates unchanged. However, it further increased the amount of the reverse repo from 4 lakh to 6 lakh crores and also extended the maturities of the repos from for up to 28 days. So this was a strong message towards further normalization of the monetary policy in a gradual way. In a still more important indication, the Reserve Bank did not continue with the government securities acquisition program, under which it had bought bonds of about 2.2 lakh crores in the first half of the year. The market had banked upon the GSAP to be a stabilizer in the face of the higher supplies, and therefore there is no surprise that the 10-year yield during the month closed at more than a year high at around 6.38%, having increased by about 15 basis points for the month. The money market rates have begun to align with the new indication of a gradual shift of the operative rate from the reverse repo rate of 3.35 to the repo rate of 4%, because during the month all the VRR auctions had the cutoff close to 4%, like 3.99% and so on. At the global level also, Fed indicated its plan to start the tapering from the November meeting. We have the Fed meeting announcement due later today, and I expect the Fed to announce the commencement of taper. They have indicated that they will want to finish the tapering by the middle of the next year, that is 2022, and therefore we have about 6 months to complete the process, maybe 7 months. So I expect the Fed to reduce the bond buying by between 15 to 20 billion dollars per month, which is in line with the market expectation. Again, as is the case with the global markets and with India, both the Federal Reserve in its domain and the Reserve Bank in its domain has been able to soft land the markets into the tapering and the normalization of the monetary policy. And therefore, we have not seen any undue volatility in the markets. The inflation for the month of September was reported at 4.35%, largely due to the correction in the vegetable and fruit prices. However, that number is expected to inch up again as during the festive season. The market reports are that the vegetable prices have again begun to inch up. We also had the oil prices hitting a high of $86 plus during the month, which is more than a 7-year high. And the core inflation continues to be sticky. Therefore, I think on the inflation front, a lower headline number isn't a great relief at the because we expect the core inflation to continue to remain high, and also the headline inflation numbers to inch up again as we move closer to the March 2022. The government's fiscal situation looks very, very comfortable. The government should be able to easily contain the overall fiscal deficit well below the current expected projected level of 6.8. However, again, we don't expect a reduction in the borrowing program because the government may use that extra money or surplus towards other development agenda. So therefore, looking at the fact that overall the policy is moving towards a normalization phase, we expect the short-term yields to continue to inch up and eventually align with a situation where the overnight operative rate is 4%, as also the long-term rates to go up slightly. But given the fact that the second half borrowing program is lower than the first half and there is a certain amount of optimism about the fiscal deficit being contained within the projected number. The long end, having already priced in some amount of negativity, should hold relatively stable. So therefore, we expect the yield curve to somewhat flatten from the current levels, although we have seen a reasonable amount of flattening already. In this environment, I believe the low duration category and the short-term category are the two funds which will address the current situation well, and therefore I believe those two are the respective ones for the investors with short-term and medium-term investment horizon to look at. Thank you very much once again. We are going through a rather volatile and uncertain time, but I believe the clarity is emerging as to the normalization, and our strategies and portfolios have to be aligned accordingly. Wish you all the best once again. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.